Welcome to another S&P 500 analysis. Today is February 5th, 2023. We will continue to see a market fighting with the Fed. When the fight is over, there can only be one winner, either the Fed or the market. My bet is on the one that has to go. So who do you think has to go? In this video, we'll analyze the price action of the S&P 500 and the other major market indexes, the market sentiment, market internals, the 10-year yield, US dollar, oil, silver, and gold, and see what they are telling us. Stay tuned. Last week, the market did not see any news other than good news. At least that's how it behaved when it decided to focus on the $40 billion buyback announcement from Meta. Instead of on its missed performance, the market rewarded the announcement by pumping the stock price up more than 20% in a single session. Then we have the tone-deaf market that simply ignored Jay Powell's repeated warning that the job on bringing down inflation back to 2% is not done, and it still has a long way to go. In other words, do not even think about a possibility of a Fed pivot, a fancy talking head phrase for a rate cut, anytime soon. And finally, on Thursday, Apple, Amazon, and Google reported their earnings, and none of them provided a rosy future. So what did the market do? You got it. Pump it up and ignore what's to come. Now, talking heads are telling you to focus on the long-term outlook. Tim Cook said production level for Apple's product is back to where it needs to be. What level is that relative to demand? Now, the talking heads don't want to ruin the party, so they won't question that statement. Instead, they just rationalize the miss from last quarter and saying that it will spill over to the current quarter and the next earning report will be much rosier. Well, I guess Tim Cook just keep that to himself for now if that is true, which I doubt, because last quarter miss was not mainly due to lack of supply. There was a reduction in demand as well. Now, how much was that? Well, if it has a material impact, then I'm sure Tim would be more than happy to tell us, won't he? And by the way, when was the last time that the market moved based on long-term outlook? Never. Wall Street make money by moving money around, not by letting it sit idle. In other words, by trading. That long-term stuff, it's just a game Wall Street used to gain access to retail investor money for them to make money in the short term. Now let's take a look at the performance of the indexes. As you can see from this table here, the Dow Jones Transportation year to date is the best performer, and the Dow Jones Industrial is the worst performer. And also, if we look at the week to date, the Dow Jones Transportation was also the best performer last week, and the Industrial was the worst performer. And looking at the 11th sector in the S&P 500, we see from this table here, the communication is the best performer year to date, and the utility is the worst performer. And for the weekly basis, last week, the best performer was also the communication, and the worst performer was the energy. Now let's take a look at this weekly chart of the S&P 500. As you can see, last week it was quite a strong week for the S&P 500. Had a range of 179 point, almost 180 points, and it gained almost 66 point or 1.62%. And it is continued this one-time framing up, and it broke this trend line here and made a new higher high on a near-term basis. So we're basically watching this high to get taken out, and that could be the first sign of breaking this lower low, lower high downtrend. Looking at this sentiment chart here, we notice that the VIX is under 20, is close to the week at 18.33. And also the put-call ratio is back up above the 0.75, close near the 0.8 level. So the market participants are still in a little bit of a hedging mode, so they are not totally risk on. And looking at this internal, the up-down volume ratio is pretty anemic when we see that a strong rally took place on Wednesday and Thursday. The up-down volume ratio is only somewhere around 2-to-1 in favor of the upside, and the advanced decline is only 1,300, 1,400 or so. So it's not that broad-based, like in the 2,000 level when we see such a strong rally in the S&P 500. In the New York Stock Exchange, the new 52-week high versus new 52-week low, the 52-week high outnumbered the 52-week low by a margin of 120 on Friday. And looking at the cumulative AD line from New York Stock Exchange, we see that it is accelerating upward, and so is the SP 500. And it also took out this pivot high here. Remember, we were saying that the positive divergence need to get resolved by taking out this high, and indeed it did that last week. So now there is no divergence. Look at the internal for the NASDAQ market. As you can see, for the Wednesday and Thursday rally, we did see a up-down volume ratio in the range of 5 and 4 to 1 in favor of the up volume. So it's slightly better than the New York Stock Exchange. But the advanced decline, the daily advanced decline, also a little bit weak. It's not as strong as we would like to see it. When you see a strong rally, we expect to see the advanced decline, the advanced outnumber the decline over 2,000 level. But we are not seeing that on Wednesday's rally, and we sort of just barely got above that 2,000 level on Thursday. And the new high, new low in the NASDAQ market is performing similarly to the New York Stock Exchange. The number of 52-week high outnumber the 52-week low by a margin of 118 on Friday. And the cumulative AD line for the NASDAQ market is also accelerating upward along with the NASDAQ 100. So overall, the internals are telling us that the recent rally is not as strong as it needs to be or is supposed to be, but we are seeing a little bit of a strong move on the cumulative AD line. But the individual up-down volume ratio on all these recent rally kind of very anemic. It doesn't show that there was that strong buying pressure. So we got to be cautious about that. Although the market participant was not very fearful, but they are still in a hedge mode. So they are not totally risk on. Now let's take a detailed look at the price action of the S&P 500. As you can see, last week it actually came up and broke this balance area and made a move above this upper range of the expected move. Then on Friday, it closed back below it, but still above this balance area here. For the coming week, the market is pricing in a upper range of the weekly expected move between 42.25 and 4209.50. And the lower range will be between 4063.50 and 4040. So those are the ranges for the coming week. And here's the scenario that I will be watching, because right now on Friday, this candle is not one of the most bullish candles that one want to see for a continuation of this uptrend, right? This little short-term uptrend. So instead, I will be looking for a price to pull back and possibly test this level here down near this 4100 area and see what it get a bounce back up into this upper range of the weekly expected move. Now, if it doesn't get a bounce down here when it comes down and test this 4100 area and dip back inside of this balance area, then I expect the price to move down into this lower range and possibly come down to this 4,000 area near this this area here. So that's basically what I'll be watching for the coming week. And this 4,000 area could be a pivot point for it to either move down to this 3,900 or get a bounce back up and try to break out of this balance area once again. And looking at the SPY, the ETF for the S&P 500, you can see the upper range of the weekly expected move is somewhere between 421 and 419. And the lower range is somewhere between 404 to 402.50. And the scenario that we will be watching, again, I'm looking for a price to pull back a little bit and possibly come down and test this 410, 411 area and see would it get a bounce back up into the upper range of the weekly expected move. Now, if it doesn't, let's say it come back into this balance area, then I'm expecting this lower range to get tagged and possibly come down to this 400 level. Now, keep an eye on this composite point of control somewhere near this 395.50, because that would be a key level to watch if it breaks the 400 level. And for the NASDAQ 100, as you can see, the NASDAQ 100 move above the upper range of the weekly expected move last Thursday. And then on Friday, it was trading up above that level before it pulled back and dipped back inside of this weekly range and closed just underneath the upper range and left a gap here. So for the coming week, the expected move upper range will be between 13,000 and 12,915, and the lower range will be between 12,230 and 12,130. Now, what I'm going to be watching for the NASDAQ 100 next week is for the price to come down and fill this gap and come down to the lower range and see would it get a bounce back up and essentially come down and test this edge here of this balance area or this huge, you could call it a triple bottom or double bottom or whatever you want to call it, but it is a consolidation area, and this is the level that you want to keep an eye on, somewhere near this lower range of the expected move down in the 12,130 area, and see would it get a bounce back up. Now, if it doesn't, if it come back in, then we'd be watching for these levels down here, possibly this 11,500 to get tagged, and also these low gap get filled. So if we look at the QQQ, the ETF for the NASDAQ 100, see the market is pricing in the upper range for the weekly expected move between 317 and 314.7, and the lower range is somewhere around 297.70 and 295. So for the coming week, the price action that I'd be watching, the price scenario, is to come down to the lower range and possibly test this edge of this balance area, and that would be near the lower range of the expected move, and see would it get a bounce back up, like we said, on the NASDAQ 100 cash index. And if it doesn't and dip inside of this balance area, then I'd be looking for the price to come down to this composite level here, this composite point of control somewhere around 283 area. So that would be the level that I'd be keeping an eye out if it dips inside of this balance area. So there's a little gap here that we also keep an eye on and watch these level down here, this 284 and the 283. The Russell 2000 had quite a week. Look at the upward movement here. It almost went parabolic straight up, but it did pull back a little bit on Friday, and it is printing a inside candle here. So look for a little bit of a pullback. Wouldn't be surprised to see it come back down to this 1900 level here, essentially coming back into this balance area, this upper edge, and see where it finds support and bounces back up. And once again, if it dips inside of this balance area, then I'm looking for a move to take it back down into this 1775 area. And here, looking at the IWM, the ETF for the Russell 2000, see that the upper range for the weekly expected move is being priced in to be somewhere between 202.40 to 201, and the lower range is somewhere around 193 to 191. So the price action that I'd be watching, the scenario is to come back in, tag the lower range and possibly breaks it, and move below it and come down to this this area here near the 190 area, and see would it get a bounce back up. And if it doesn't, I'll be looking at this 185 level here, then possibly come down to this 182, this composite point of control for potential support. And here, looking at the Dow Jones Transportation, you can see the Dow Jones Transportation had quite of a performance last week. And although it printed an inside candle on Friday, so we could expect to see some pullback and possibly come back down to this 14,974 area and test this zone here to see would it be able to get a bounce or come down to this area here near this these pivot high for potential support near somewhere around 14,500. So if it continue to move up, I wouldn't be surprised to see this 16,700 to get tagged. I think the transportation still have a little bit more way to go, although one could say that it is overextended. So maybe a little bit of a pullback but this is certainly telling us to be on the lookout for the Dow Jones Industrial to do something. And here, looking at the Dow Jones Industrial, as you can see, the Dow Jones Industrial is still lagging behind the Dow Jones Transportation. And based on the Dow theory, that tells me that I'm expecting the Dow Jones Industrial to come up and take out some of these pivot high and possibly come up to this 35,500 area. And that is probably when we see the rotation of the sector going back into the value and also back into the defensive stock. So we could see a little bit of a rotation back out of the technology stock and into these defensive stock, and that's when we will see the Dow Jones Industrial make its move a little bit upward and try to take out this level here near the 35,500. And for the New York Stock Exchange Composite Index, we're also seeing some movement on the upside as well. It's not as strong as the Dow Jones Transportation or the Nasdaq, but it is making some headway toward the upward direction. So we could see a little bit of a pullback and possibly maybe testing out this 15,800, 15,900 level, and then get another push. And looking at the ES, the E-mini S&P 500, I'm looking for a price to come down and possibly test this edge here. And that would be somewhere around 41.25 to see would it be able to get a bounce and bounce back up to the upper range of the weekly expected move between 42.35 and 42.19.5. And if it unable to get a bounce off of the 41.25, then I'd be looking for the price to come down and test this lower range of the weekly expected move between 40.72.5 and 40.50, and possibly break below this lower range and come down to this 4,008, this composite point of control. So basically coming down close to that 4,000 level and see would it be able to get a bounce off of that high volume node. Looking at this market profile chart for the ES, the E-mini S&P 500, you can see we have a point of control got tagged last Friday, the Thursday point of control. And right now, we still got a lot of these single prints that need to be get tagged. So for next week, if the price start to come down, I look for these single prints here to get tagged and possibly push down to this point of control. And look at this right here. I have marked off the FOMC rate announcement that's seen a decline on February the 1st, and that level is 40.73. So remember, we are looking at the candlestick chart, the lower range of the weekly expected move that the market is pricing in is between 40.72 to 40.50. So if it dips down and tags this FOMC, then look for that lower range to get tagged. Looking at the US dollar, we see that the US dollar have broke this downward trend line here on Friday and made a move up to this 102.99 area. We could see that the continuation move up to this 103.80 and possibly get back up to this near this 105 in the coming week. So keep an eye on the dollar. I think the dollar is probably coming back up and bouncing back up toward this 105. And we saw the 10-year yield came up as well. It bounced off of this 3.4%. And right now it's sitting at this 3.5%. So wouldn't be surprised to see it come back up and break this trend line next week and move toward this 3.9. And we see the 10 and the 2, the inversion got deeper now. It came back down to 0.769. And looking at the oil, if we see the dollar continue to bounce, then we could see oil to continue to move downward. And we could see the 69.50, this area here, get tested. So keep an eye on this 69.5 area on the downside. But if it could move back up above this 75.50 area, then it could come up to this 80 level. This is this composite point of control here on this profile. So those are the near-term level to keep an eye on. Upside somewhere around 80, and the downside is this 69.5. And last week, we saw silver broken out from this balance area on the downside and move down to this 22.5 level, this zone here, right now sitting at 22.40. So if it continued to move down, we'd be watching for the possibility of coming down to this 20 area, unless it could come back up and get back inside of this balance area and then chop around to try to work itself back up to this 24.48. Gold was also under pressure last week, and we see that gold booked below this 1920 level here, this 1910 area, and now it's back down toward the working down toward this 1850. So I wouldn't be surprised to see gold come down and test 1850 to see would it be able to find support and bounce back up. And if it doesn't, then I'll be watching for gold to possibly work its way back down into this area here near the 1750 area, somewhere around this area here. That's basically what I'm looking at for gold. And the key level to keep an eye on is 1850. In summary, the SP 500 made a near-term higher high with the help from the large cap tech stock. From the market internal and Friday's price action, I'll be watching for a pullback this week. And if what the Dow theory is telling us materializes, then we will see the rotation from the tech stock back to defensive stock to take place. And that will push the Dow Industrial back up, and we'll likely see the Dow Jones Industrial to outperform the S&P 500 and the NASDAQ. And that will likely be the end of the fight between the market and the Fed. If you are new to this channel, be sure to subscribe and turn on the notifications so you'll be notified when I release my video. And if you'd like to see more of my analysis on the large cap tech stock, then go check out my Substack page at smtraderCA.substack.com. And don't forget to smash the thumbs up to help me promote this video on YouTube. Thank you for watching and stay safe.